Hello, everyone, and thank you for attending today's webcast on how FASB's proposed amendment to ASC Topic 820 will impact alternative asset investors. Before I make introductions and get into the presentation, I'd like to cover some brief housekeeping items. This webcast is being broadcast live. We suggest that you enlarge your media player to full screen when viewing the presentation. We encourage you to submit questions throughout the presentation. You can submit questions electronically through the webcast console, Q&A, the widget at the bottom of your screen. If we don't have a chance to answer every question, we'll be sure to follow up with you directly after the webcast. A recording of today's webcast will be posted to our website and distributed to all attendees, along with the slide deck in due course. CPE credit for this presentation, one CPE credit will be provided for those who complete the 4 poll presentation. And an on-demand version of the webcast will be available on our website in the next few days. I'm very pleased today to be joined by Jim Croker. Jim is the Vice Chair of the Financial Accounting Standards Board. Jim was appointed a member and Vice Chair of FASB, the Financial Accounting Standards Board, in 2013, and later reappointed to a second term that extends to June 30th of 2024. In his role, he assists that FASB chairman in representing the board to the external stakeholders and in conducting its internal operations, in addition to serving as a voting member of the board. Prior to joining FASB, Jim was with Deloitte and as chief accountant at the SEC. I think I first met Jim during the financial crisis when he was at the SEC. When I presented on some fair value issues a decade or more ago. Welcome, Jim.
Thank you.
I'm David Larson, a Kroll Institute Fellow and Managing Director at Kroll in our Alternative Asset Advisory practice. I've been with Kroll now for a bit more than 15 years, and I was with KPMG for 22 years prior to that. I am an auditor in a former life. Today, I focus primarily on fair value related issues in the alternative asset space. I serve on the Standards Review Board of the International Valuation Standards Council, the AICPA task force that in 2019, after a 6-year effort, published a guide on private equity and venture capital portfolio company valuation and accounting. I sat on FASB's Valuation Resource Group as the private equity representative during the financial crisis back in 2007 through 2009. And I've been a vice chair of IPEV and an advisor to IPEV, the International Private Equity and Venture Capital Valuations Board, that is also active in promulgating alternative asset space. You will have noticed that our session today is under the moniker of Kroll. In 2018, Duff & Phelps acquired Kroll, and we began transitioning our firm to the Kroll brand in 2021. We've announced that our alternative asset advisory practice is now under the Kroll brand, and so it makes it much easier when you reach out to us to reach with a kroll.com email address rather than our old Duff & Phelps email address. World and digital products related to valuation, governance, risk, and transparency. We work with clients in a wide variety of industries. We work with in providing expert services, investigations, cybersecurity, corporate finance, restructuring, legal, business solutions. We have almost 5,000 professionals in 30 countries and territories around the world. Again, with the change in the Kroll name, no change in our ownership, no change in our management. We can remain committed to our supporting transparent valuations of illiquid and difficult to value investments. That's where we are in this context in our alternative asset advisory practice. And we work with regulators and that we can pragmatically distill down the valuation-related items that all alternative asset managers are faced with. And as we get ready to as I put our first polling question up, again, we need to answer the 4 polling questions for CPE credit. I'd just like to remind you, if you haven't registered yet, on November 9th, we've got our 15th annual Alternative Asset Evaluation Conference. We are also looking to launch in the next few weeks or months our podcast series, Alt Look, Kroll's Alternative Investment podcast view on the alternative asset market. So if you could complete the polling question, I'm going to shut that down in a second. There's sometimes a little bit of a delay from the time it pops up until I've been able to get resolved. But we'd just like to know kind of what type of entity you represent today to get a feel for the overall audience. So I'm going to shut that down now in just a couple of seconds. And so I'll go to the answers. So as expected, we got a third of you are, let's say, in the GP realm, that you're producing financial statements for your funds to the investors, the LPs. Almost a fifth of you are in that LP realm. And then a good number of others are in the valuation world, the auditor world, or other service providers. So we welcome all of you today. And again, please provide way. And again, we will provide both a link to the replay of this session and the slides in due course. So Jim, the proposed accounting standards update with respect to fair value measurement topic 820 was issued in September, just over a month ago. You're looking for comments by November 14th. If we could just maybe touch a little bit on what drove FASB's decision to make this tweak, and I think one of the questions that I've received since it's come out is that there's been a good number of people that have asked the question, is it common for there to be, let's say, an exposure draft? So if you could just kind of touch a little bit on why the update was proposed, kind of what the reasons for, possibly some of the reasons against. I know that you're listed as one of those that have outlined some things that maybe should be tweaked in going forward. But I'll turn it to you to kind of give us kind of an overview of why we are in a situation where we need to respond to this invitation to comment about the proposed ASU.
Sure, and one, thanks for the invite. And before I get started, those who've heard anyone from the FASB speak before, you could expect that I have a disclaimer that my views in today's discussion are my own and don't necessarily, and in this case, actually don't reflect the views of the majority of the board. And so with that, let me just get into a little bit, I guess, David, on your first question, why the change? What prompted the FASB to take action? One of the areas where we look for potential projects is through agenda requests, where we see either diversity in practice or potential improvement to financial reporting, particularly if it improves financial reporting for users of financial statements. This happens to be the accounting for equity securities that are subject to contractual sales restrictions was the subject of an agenda request from one of the large accounting firms asking us to take on a project to address, at least in their view and based on our staff's research, diversity in practice with respect to how contractual sales restrictions are accounted for. That is, there was mixed practice, some incorporating the impacts of those contractual sales restrictions into the determination of fair value, and others who weren't incorporating that impact into the determination of fair value. It was the view of the board that, one, this was an issue that was sufficiently pervasive and had a viable scope, viable alternatives that we could address the accounting, and eliminating the diversity in practice in this area would be a benefit to users of financial statements. I guess in my personal view, unfortunately, the board concluded that you would not incorporate the determination or the restriction into the determination of fair value. I think we'll get, David, into some of the details as we go forward, based upon a view that it is not part of the unit of account. That is, the restriction is really separate from the security. It's an attribute of the holder of that security as opposed to an attribute of the security itself. And there was a minority of the board, in this case, 3 board members, who, whether the restriction is a feature of the security or it is really just a separate contract that the holder of the security enters into, really didn't impact our view. That is, the economics of those restrictions nonetheless impact fair value, and in this case, of course, reduce the value of that security from what would otherwise be the quoted market price. So we have the way our standards are set is there's 7 board members. Standards are set by a simple majority of the board, but we do go through, in all cases, an exposure draft to seek input on the board's conclusion. So if you read this ED, and it's relatively short, I think it's about 20 pages, you'll see sort of both views outlined, the majority of the board view as well as an alternative view of the 3 dissenting board members.
So Jim, this ASU would impact any equity security subject to a restriction, not just those in the alternative asset world. If you're a nonprofit, if you're a corporation, all of those, as it's, I know that we kind of like to have accounting standards that are kind of overreaching or wide and not necessarily. To what extent does the board kind of take that into account when you're looking at a standard such as this, is the impact on particular industries? Again, our goal today is to talk about the alternative asset industry, private equity, venture capital, hedge funds, and the like, and we'll get more specific in a moment. But as you're kind of as the board is putting a proposal together, are you looking pervasively, and if it works for one side but not another, how does that kind of impact things?
Yeah, it's a great question, and we do like to start with standards that account for similar economic phenomena or transactions consistently, irrespective of industry. That's sort of a general starting point. If a alternative asset manager holds an equity security subject to a restriction, and a not-for-profit holds an equity security subject to a restriction, so you would think that the going-in point is that contractual sales restriction would have a similar impact on the economics, irrespective of the holder of the security. And that's sort of the going-in point, but in my view, you then have to take a step back and say, well, is that really the only factor to consider? And I think you also need to consider cost, benefit, and particularly for asset managers or investment companies, as they're classified in our codification, all of the accounting for the activities of an investment company is done at fair value. So they hold assets and mark them sort of irrespective of whether it's equity security, debt security, or an other alternative investment. that might differ from the users of the statements, or that then strikes a net asset value. And so here the impact of the contractual sales restriction obviously has a direct impact on not just the fair value, but the resulting NAV and the resulting performance of the fund. In fact, could impact fees and other things down the line, which may differ from other types of entities. Take a private company or a not-for-profit that has a small portfolio of securities that are subject to a contractual sales restriction. Maybe the cost-benefit payoff is different, and it's actually one of the things that we outline in the alternative views of the board members who disagree with the proposal. Outline that, our going-in point would be that contractual sales restrictions ought to be factored into the determination of fair value for all, but again, maybe different impacts for entities outside of the investment company space. So as an alternative to that, I think there are 2 or 3 of us that would be open to saying, well, at a minimum for investment companies, contractual sales restrictions ought to be factored into fair value. Would really be interested in that feedback from respondents.
And I think a couple of things, and we'll reiterate this again towards the end. You made a comment about cost benefit. I want to table that. I want to come back to that a little bit later. But I also want to say what you just said. FASB does listen to comments. You're looking for comments on this proposal. So anybody out there, whether whoever you are, writing a comment letter is something that FASB wants to hear about. They want to hear it. They want to hear your perspective, and be able to evaluate that information in the final deliberations conclusions. I also I often start with a slide on just a reminder on what fair value is. I felt like in many ways we all know it, but I just want to do a quick reminder that fair value, by definition, is the amount that would be received in an orderly transaction using market participant assumptions as of the measurement date. We get a little bit kind of when we have a level 1 input, an actively traded security, this is where kind of things come into, it becomes a little bit more dicey, because you can say, all right, if it's a level 1 input, unrestricted, P times Q is the answer. 10 years ago or 15 years ago, when we were debating 157 and the application, the question of blockage kind of fell away, and we kind of lost that battle in the alternative asset space. But from a contractual restriction, what we're talking about here is things like an underwriter's lockup, a restriction. 2 parties maybe own together a publicly traded security, and they agree not to, one or the other party agrees through contract to sell. So that's the contract or the contractual restriction, which can be differentiated from a legal restriction where there's a provision in law that would prevent trading of a security, for example, through 144A or other rules that the Security and Exchange Commission may have. We'll get back to that a little bit more in a moment. What I do want to go to is our next polling question, if I can bring that up. It'll help a little bit in guiding our discussion, and it's really to say, do you believe that a contractual restriction should be considered as a feature of the unit of account in an equity security? And I think, Jim, you kind of mentioned that some of the board believes that part of the unit of account. I guess I've always had a different take on it. Well, that may be technically correct. From a practical perspective, you can't sell these securities because of the contract, and therefore any market participant would take that into account. So whether that's an underwriter's lockup, whether that's some other type of contract. So how let's say that kind of view that somehow, even though you can't sell and a market participant would take this into account, but somehow we have to kind of ignore that.
Yeah, and so, I think 157 tries to identify whether a restriction is an attribute of the security, and I think you talked about, restricted securities subject to 144A, where the restriction transfers. with the security, or whether the restriction is really separate and apart from that security. And I think it's a pretty fine distinction in my mind. I think the example where you've got two entities that hold securities and they agree amongst themselves contractually not to sell, probably for some consideration, that contract might not even be with the issuer of the security. So you've got multiple counterparties. And I think you can construct an accounting argument that says that contract is really a contract separate and apart from the security. I personally think, at least as it relates to restrictions on sale, that they're so integrated that even if you viewed it as a separate account, it changes the value of nothing other than the security. It's not like you might see in other spaces, somebody donates medical devices to a not-for-profit and says these are restricted for use outside of the United States. The purpose of that is really, I want you to use that for your intended mission. I think here it's, when it's literally you can't sell, it becomes an accounting distinction more so than an economic one, which is why, whether you want to read 157 or 820, I guess now that way or not, we're the holders of the pen. So if we think there is an issue, we can adjust the language in 820 to say a restriction of this nature, whether it's with the issuer of the security or incorporated in the security or not, should be factored into fair value because it's really not separable from the security.
So I want to close out the poll. Hopefully you've had a chance to respond. We'll see what our answers are. And again, it's not scientific, but just as a takeaway of our audience, almost 3/4 believe. Again, just under a fifth of you say no, it shouldn't, and then and very few. I wanted to spend going to very briefly touch on, and I may not even have a chance to go through all of these, but a few of the pieces within the standard that would be changed. I'll just do this very, very kind of rapidly because I want to get to an example or two that we can discuss. So again, fair value is that price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And so we always look at, and in the current language of ASC topic 820, paragraph B in 820.10.35 2B says restrictions, if any, on the use of the asset should be considered. I think one of the things, and I will come to this, I think, in the next slide, or one of the coming up slides, is one of the appendices in 820 was modified way back in 2011. When we looked at the original statement 157, when it came out, it talked about just a legal restriction. In 2011, the words legal or contractual were added, or the or contractual language was added, and when things were harmonized with the International Accounting Standards Board, and they issued IFRS 13. So I think that there is a proposed change to the master glossary that then impacts how the standard kind of looks going forward. So then we look at, and this would be the proposed change that would say basically take away the ability, if you had something like an underwriter's lockup, to apply a discount. And again, that's in the proposal, so that we'll talk about that more in depth and kind of through some examples. And then in kind of the paragraph is in the appendix. Again, the wording changes, and I just realized that I had some of my slides that had the strikeout language there, and maybe the strikeout language didn't end up in the slide. So go back to the FASB language, and it'll show you exactly which words are changing. So what I want to do is really kind of come to say, all right, what would be some practical examples of the impact on the alternative asset space? So I've got 3 examples, and I kind of walk through them. And Jim, I know that you wouldn't necessarily opine on the facts and circumstances, but it's because I kind of walk through each of these examples, kind of your view and what kind of the takeaway would be. Do we get better accounting with this change? If at kind of face value or based on the premise that's articulated. So the first example says, all right, I have a security. I'm a private equity fund. I'm reporting to my limited partners a net asset value on a regular basis. And I issue I'm involved with a security that IPOs. I IPO at and I own as the fund 1,000 shares, $1 million shares in this case, and at $50 IPO price, a $50 million value. Under current GAAP, when I report my net asset value to my LPs, if I assume a 6-month lockup and assume that comes to a 10% discount, and we're not going to get into how we do that. There's ways to do that are objective and replicable. Then I would be reporting to my LPs in my net asset value 45 million. Under the proposed GAAP, the answer would be 50 million. So it's the nothing's changed in the facts and circumstances, but the ASC topic 820 changes such that the discount would not be appropriate in this fact situation. Now, Jim, as I've read through the exposure draft, it talked about, well, and if this kind of thing happened, it wouldn't be very, I can't remember if the word was material or significant, so it's not that big of a deal. Is getting the accounting right the right answer, or not let's say getting a path of less resistance?
Yeah, so I think ordinarily you'd say let's strive for accurate accounting. There might be times where we say, in this fact pattern, and we did that in a lot of standards. We do that in revenue recognition. We say you don't need to account for, and I'll get the words wrong, but effectively de minimis promises in the context of a revenue transaction. I personally view this as a little bit different. I don't think we could say that in all cases the impact of contractual sales restrictions would be immaterial, both individually and certainly in funds in the aggregate. So my personal view would be let's get to the right accounting. If we need to then provide practical expedients where the impact is de minimis, we could think about what those might look like. So I personally think in your example A, the right answer, assuming that the valuation impact is correct, is that the economics would say you've got a NAV of 45 million. I think the majority of the board would say that's really a separate contract. And I guess one observation, I think in current practice, perhaps you could get to either answer. Some incorporate the impact of restrictions, others don't. I know, David, the AICPA guide that you worked on and talked about earlier actually provides guidance that says you would incorporate that impact. So I guess one benefit is at a minimum there would be consistency, but I would strive for consistency on what I think is also probably the closer to the economics.
Well, and I think one other question that maybe pops up, and hopefully that'll be teased out in the comment period, is the potential for divergence with IFRS 13. Now, I know that some have argued, maybe argued that IFRS 13 is a little bit ambiguous. And with this, would argue that IFRS 13 is it may not have the appendix, but I'd say the inference when it talks about level 1, 2, and 3 and taking into account restrictions from a market participant view, definitely I'll say allows the restriction or or the discount to be taken in this case to come up with the 45. And I would argue in most cases, practice would come with the 45. So if FASB were to make the change, I would argue there would be a divergence with IFRS 13. And that could create a problem for limited partners who use the practical expedient through GASB 72 or through ASC Topic 820 to use last reported net asset value adjusted for market conditions. If it's fair value based, that maybe they can't use that anymore, because if it's a fund that reports under IFRS, which now would be a different basis than US GAAP, does that mean they can't use that and they have to come up with some other way to value a fund interest? I think it starts to raise a number of additional questions.
David, I think that's a great point, and we ask a number of questions in the exposure draft, but even in areas where we don't, say, have a question about comparability with IFRS, for those who have either the fact pattern that you illustrated, or for those that have significant experience in doing valuations under IFRS or auditing them, I think pointing out whether or not this results in global diversity is useful for the board to know and understand through the comment process.
So let me move to the second example that we've got on the screen. And it's a kind of a real life example, slightly adjusted to protect confidentiality. Fund A invests $500 million into a special, and Fund B invests $150 million into that same SPV. So they have $650 million of cash in the SPV, and they use that $650 million to purchase some a actively traded security that would be valued at P times Q. So within the SPV, the value is effectively P times Q, whatever the value is. Now the SPV itself doesn't trade actively, but the unit of account for Fund A and for Fund B would be the interest in the SPV. But the contract is structured in such a way that Fund A receives the first $650 million of returns, even though 500, and Fund B gets the next $300 million. So in other words, they kind of be able to get pari passu after a certain point in time. So in other words, the kind of first part of upside Fund A gets, and the latter part of upside Fund B gets, and then they kind of go in step together. But Fund A, on day one, they're locked up. They cannot exit this SPV for through contract. When I say they're locked up, for 4 years, unless Fund B decides that they can exit, meaning that the value has gone up substantially. So if we kind of play this through and say, all right, what does this mean? In today's world, I invest 500 into an SPV. From a calibration point of view, I have a claim on the first 650 million. I probably wouldn't write that up to 650 million on day one. I would look at, I invested 500, I have a claim on 650, but that's not for 4 years. And so that 4-year time frame kind of implies a discount of 23%, just pure mathematics, of the 650 back to today. So from a calibration point of view, which we know we have to do, we've got my 500 million I invested is still my fair value for Fund A. That's what the investors in Fund A would want to see. And the fair value for Fund B would be the 150 that they invested, even though they don't have claim on that first 650, but because of the way the contract is structured. But now we get kind of very judgmental to say, all right, if I have this fact situation and I have the new accounting standard, does that start to tell me well, Fund A's value on day one jumps to 650, and Fund B's value on day one jumps to 0 because I can't take into account contract and the contractual restriction. Now, maybe I've pushed that a little bit too far because of the unit of account of the SPV, but most of the time when we have a pass-through entity, we kind of look to the underlying securities. So, Jim, is those kinds of things? Do you feel like the ASU or the proposed ASU is clear enough that we're not going to run into questions as to whether we have to, let's say, do that immediate write-up to 650 on Fund A and write down to 0 for Fund B? Or do you think people will be able to kind of work their way through it?
So this example is one I do struggle with a little bit more. I don't think it was necessarily when the majority of the board said you don't consider the impact of the restriction. I think you still would consider the impact of the disproportionate sharing of returns, but exactly how you would do that, I think you raise some good questions that I think people will then need to work through is how do I separate that disproportionate sharing, one as part and parcel to a contractual sales restriction that sort of allows these entities to come together and agree to that over a period of time. Are those interrelated? And so I think it does raise. I would hope that people wouldn't think the answer is I have an immediate $150 million gain and a likewise loss on Fund B's accounting. But I think interesting questions.
So let's touch. I mean, SPACs have been a lot in the news of late, and I'll do this one quick, and then we'll kind of hit our last two polling questions and get towards the end. But one of the questions that's out there is founder shares and whether those founder shares, when they become, let's say the A shares are equivalent to the B shares. Again, I've given an example, and maybe I've contrived it a little bit. But if you, the moment you start to go down a path where the contractual restrictions are to some extent ignored, you could end up with a fairly significant difference in fair value, whether that's $3 a share for the A shares versus $10.50 per share for the A shares. So I highlight it as those kinds of things that in the context of the if the proposal is enacted as it's currently drafted. Let's move to our third polling question, and that is, should FASB proceed with the amendment? And again, I think what I mentioned that I wanted to come back to cost benefit, and maybe and I'm not trying to skew the example or the question and the results as people respond to the polling question. But Jim, when you evaluate cost benefit at the board, where and it feels like that's been much more a consideration in let's say in more recent times than maybe it once was. Maybe it's always been there. But I come back to my question of what's more important, the right accounting answer? If I think about things from a SOX perspective, we have to have internal controls that give us the correct accounting answer without really respect to materiality. But as we're writing accounting standards, should the right accounting answer be the primary driver, or should the cost of actually implementing the accounting standard be the primary driver? And how do you kind of weigh that in coming up with the decision?
Yeah, and I think my view is each board member would say, let's start with getting the right accounting. There could be disagreements over what the right accounting means, particularly when you're outside of a space like fair value. We could disagree or agree or disagree on whether or not, for example, pensions ought to be measured at fair value with gains and losses through the income statement immediately. Others would say, no, they're 40-year obligations and you should do what we do today and pension accounting. But I think each of us would start with, well, let's get the accounting accurate. Let's have an understanding of what we think that is, but then let's also layer on to that of, is what we're asking people to do in an area that it's going to make a difference to users. So do we need perfection if users aren't seeking that level of information and it's not relevant to their analysis? I think my example on RevRec earlier is, I could have de minimis promises, but if users say, look, we sort of understand that, and actually getting internal controls around de minimis things and tracking those might be, sort of a regressive exercise, then I think we do factor that into our analysis on should we require that or not. But I would go back to, I think each of us starts with, well, let's start with what do we think the right accounting is. We might have here a difference in the board of whether or not this is pervasive enough to actually matter to users. My personal view, particularly in investment companies, is it does. I might have a different view if you said, well, what should we do with non-investment companies? How pervasive is it that an operating company holds a significant portfolio of securities that's subject to a contractual sales restriction? By the way, how are users using that information? Are they actually valuing an operating company based upon the fair value of its securities holdings, or do they do a more fundamental analysis of operations, and that's just one small impact? So I would say, perhaps there is a different cost benefit for operating companies versus those who invest principally in securities.
Got it. Let's close out this polling question. So should they proceed? Again, it's very similar to, is there a problem in our prior question about 1 in 5 said, yeah, go forward. Maybe that's because of that cost benefit. But 60% say no, don't do it. And a full 20% or so are not sure yet. And very, very minor group that don't think it or think that it doesn't matter or in the overall context. So as we look for, just to touch on a few more things to make sure we're holistic, is the effective date, when it becomes effective, if it becomes effective, would say that, would really look at it from the alternative asset perspective on a prospective basis, meaning that new contracts entered into after the new proposal becomes effective, again, if it does become effective, it would apply to those. So existing contracts where there's a contractual restriction would still have would still be allowed to have the discount. New contracts would not be allowed to have the discount. I've got that basically correct, Jim? Yeah,
and I think that particularly for alternative asset managers, that is the proposed transition. We'd certainly be interested in, both the majority and the minority of board here, I think, would be interested in the operationality of this transition, separating old contracts from new. The proposal was done this way so as to avoid having a day one impact on net asset value associated with adoption, but certainly be interested in perspectives of commenters on that.
So in the overall context, you've asked 7 questions. They've outlined, and again, you can find those with the exposure draft on the FASB website. If you can't find it, we can always help to get it there, get you to the right place. Let me come back to, and I asked this before, but I just want to say, all right, Jim, let's say you get a bunch of responses or you don't get a bunch of responses. How does that impact your final deliberations in whether you move forward with the proposal or not?
Yeah, I would start with whether you agree with the proposal or disagree. We're interested in your your feedback. I think oftentimes we hear that if people agree with what we've proposed, they might tend not to comment. I think in any circumstance, it's useful to comment if you have an interest in the topic, whether you agree or disagree. We don't take the comment letters necessarily as a poll. We don't sit there and say, well, 51% of people wanted this and 49% wanted that, so we know what to do. But I think we're informed by the quality of, I'll say, the arguments or the responses, helping direct us to, you got the economics right here, or you got the economics wrong here, and here's why. I think examples, David, like the ones that you raise of illustrating, well, this could be a potential impact, helps highlight for the board, you should go this way or you should go that way. Impact on convergence and comparability. And like all of those, the board would say, yeah, we've been, informed, and we ought to move forward, or there's new information. And I would say particularly interested in, and I think all board members are, the impact to users of financial statements. So to the extent that you have a view on that, whether it's, in the determination of NAV, it would have, the appropriate impact, or it would have an inappropriate impact. How does it impact the users of financial statements?
Got it. So let me move to our final polling question. And that's following up on what Jim just said. Do you plan to respond to FASB? As I think about what you just kind of said, Jim, and I'm kind of contemplating what impact this would have on an alternative asset manager. If I'm the fund, if I'm preparing the fund financial statements, I'm the general partner. In many ways, this makes their life easier because they don't have to go through and calculate actual restrictions. If I'm a limited partner, if I'm actually taking that reported net asset value and incorporating that into my business decisions, into my own financial statements, I think this opens a Pandora's box of questions. Because of it raises a divergence with IFRS 13. It raises a question of, all along we've used the practical expedient and said that net asset value is an appropriate place to be if it's as of the same measurement date, because it represents, in the context of what would you receive in an orderly transaction, it basically represents the cash that would be received if all of the underlying investments were sold in that orderly transaction as of the measurement date. So I think that it now kind of raises this kind of question, well, yes, I can use it because of GAAP, but no, it still doesn't give me a good economic answer. And then And then we start to look at some of the questions I raised with some of those examples, and we may have, I'll say, some additional divergence in practice in how you answer some of those questions because of a proposal that is intended to reduce divergence in practice. And that's my personal opinion in the context of this as we kind of play it itself out. Let's come to the end of this polling question. Go ahead, Jim.
I agree with you. I also think of it in the context of a retail investor investing in just a mutual fund, one which has securities that aren't subject to restriction, and one that has an identical portfolio that is. And I think the result of this would say you value those the same way, but obviously the investor isn't going to see that through NAV, but they're actually investing in things with different economics.
Got it. So the answers to the polling question are interesting, and again, this is not scientific, so I don't think it's an indictment per se, but it is interesting that as of at least 10% of our attendees intend to respond, 25% basically said you've already made your decision, and so it's not really worth the time and effort, and 60% haven't made a decision yet. Is it worth people's time and effort to respond?
I would say absolutely. And And I can understand the sentiment of, hey, the board's already debated this. They have a proposal. Will they really refine their or change their view? I think in almost any exposure draft, what we end up finalizing differs based upon input from respondents. So from what we propose to final, it might not always be what you recommended or didn't recommend, but I would say we're certainly better off understanding. And in this fact pattern in particular, or in this exposure draft in particular, again, the vote was 4 board members supporting the proposal and 3 that believe that the sales restriction ought to be incorporated. So I would say, first of all, it only takes persuading 1 board member to the alternative view. And of course, those of us that had the alternative view, we will benefit from knowing, hey, did we actually look at this with a full set of information, or are there things that we ought to be considering in finalizing our views as well? So I would say definitely we want to hear from you.
So I think we've hit most of our questions that have come through in one way or another. As we just came in, was dealing with whether unregistered SPAC pipe deals would be subject to a discount. Again, this proposal applies to those actively traded equity securities that have a contractual restriction. So in many cases, the unregistered SPAC deals are not actively traded yet. And so in time, you probably would have some type of impact of market participant view, either as the time to when they can be, let's say when they are registered, but the moment they become registered, but still subject to a contractual restriction, under the proposal, they would be P times Q. There would be no impact of that market participant view on the impact of the contractual restriction. So I think that's the piece to make sure that it's very, very clear that that's what would happen under this proposal.
And I think people responded to one of the earlier polling questions, David, about they viewed these as not dissimilar. And so I personally question whether we're drawing an accounting distinction based upon whether it's a contractual sales restriction versus a securities law distinction. And I can see that, obviously those are 2 different things, but from an economic standpoint, does it really make a difference? And I think maybe people are questioning, why draw an accounting line where you're proposing to draw it?
Got it. Again, there's been a few more questions come in. We'll respond to those in due course. We'll do our best to respond. Interestingly, I do think this proposal would solve one question, but I think it opens the Pandora's box of additional questions, particularly when you've got something that's convertible to public stock that's not a publicly traded or actively traded security today. I think it will raise questions and create potential divergence in practice. Again, one person's view, and we'll see how this kind of plays itself out as we get the comments. I would encourage you to comment to FASB. I've seen throughout my tenure of writing comment letters to FASB, they do listen. I think one of the best examples in my mind was way back in I think it was 2009, which issued FASB 57.3 and 157.4, and I think there were hundreds of comment letters, and I think FASB ended up going 180 degrees from what they initially proposed. So they do listen, they do react, and I think we get to hopefully we get to the right answer generally, but in particular for investment companies. Jim, any parting words?
No, great encouragement, and again, whether you agree or disagree, we do like to hear from you.
So, Thank you all for participating. Please reach out with additional questions. We'll try to follow up if we didn't answer your question live. Thank you for your participation today, and we'll get the slides out to you in due course over the next week or so. Thank you.